Hi folks, I hope everybody can hear me okay. This is Julian McCree with another Trader Cafe. Today, this week, it is a macro markets overview. So no guests, just me chatting about what's going on in the world. Now, as always with this, please, if you have any, ask me loads of questions as we go through. So what we try and do with this session is really to try and get you to focus on the strategy and the fundamentals around what's going on in the world at the moment, to try and give you a little bit of confidence about your trading. So you know, trading is about building up that confidence. And to do that, there's three different parts. We've talked about this before, right? The first thing is to identify those markets that are hot and what's going on. The second thing is to make sure you have the timing trigger. Okay, so everything is working fine when you come to put the trade on. And then the third thing is to make sure that you're managing that trade correctly and you're also managing your account correctly. So here's the thing, right? What we have to do in that first thing, that market setup, is we've got to do two things. Number one, we have to understand what we're trading. And secondly, we need to try and have a reasonably good idea about what's going on in the world. Now, that's quite difficult these days because there are so many people out there who have an opinion about things. So what I try and do on this show is to try and encapsulate it into 2 or 3 key themes that I'm working on as we sort of go through the trading quarter, the trading half year, right? These are the things that I'm thinking about and how I tend to direct my thought. What happens with this is, right, when all those fundamental views of mine line up with, say, the seasonals or the cycles, and then I get a timing trigger, then I'm really confident that what should happen is I should get a reasonably good result out of it from the trade. Certainly what I'm trying to do, as always, is to lift my trading percentage. So as you know, we have 3 key themes that we're looking to run with at the moment. This has been happening for the last couple of months, so I don't really need to change too much. I'm just going to hang around with these 3 key themes. And the reason why these 3 key themes are out there is because this is sort of what everybody's focusing on. Now, what I'm going to try and do today is to bring some light around those themes, but also equally to talk about things from a slightly different angle. Let's call it a trader's perspective. So how I'm thinking about this stuff and why I don't really agree with some of the sentiment that's out there at the moment. Because right now, if you're asking people right now what's going on, everybody will tell you that inflation is coming back. Inflation is going to be enormous, and we're going to go into some kind of hyperinflationary world. Governments are spending like crazy, and the pandemic is over. Now, I've got sort of issues with every single one of those. So really what I want to try and do today is to just go through my thoughts on it. And hopefully you might get something out of those, but equally you might be able to as well look and try and understand about what else is going on in the world and be slightly skeptical sometimes when people are recommending that you do, that you think about the world their way, okay? So when people talk about inflation, right, they talk about inflation very much in the light of, so I'm just going to move everybody down a little bit so you can see the titles. Very much in the light of the inflation rate is picking up, right? And it's all very worrying. My God, it hit 5% in America, and it's this week in New Zealand it hit 3.3%. Shock horror, right? Literally shock horror, right? This is the end of the world. Don't know how we're going to cope. Rates are going to go to 12%. Everybody's going to not know what to do, and it's going to be a disaster. Okay, so how about we get some perspective? Right, this quarter in Venezuela, they're looking at an inflation rate of 3,000. Okay, hang on a second, it's only come down to 2,700% annualized now. Sudan's still in the 350s, and Lebanon, poor Lebanon, what a crazy country that is right now, and they have a lot of problems, right, is still looking at 120% inflation. So prices are more than doubling every single year. Okay, so where do we put 5s and 3s into that? Well, trust me, the list, you have to go down quite a long way down the list to try and find any countries with 5, let alone any countries with 3, right? So I think what's really important for me is to try and get some perspective on all of this, right? So the issue that I've got with inflation is that I grant you it's there. I grant you it's picking up. I grant you it's going to remain high for 2 or 3 months, but what I don't grant you is whether it's going to stay high for very long. This has been a crazy 18 months. No economist has got this right about pretty much anything, actually, around COVID. I don't think any economist would have said house prices are going to be up 25 or 30% walking back a year, right? You wouldn't have seen that. But here we are, right? So one of the things that I want to focus on is some of the economics and the economic revisions that are going on. The first chart on the left is industrial production in America. Now you could say, look, industrial production doesn't really mean very much, but take it as a proxy for what's actually going on in the real economy in America. I think this is the key thing, right? The level of industrial production really doesn't matter, guys. It doesn't matter. What you need to look at is where all those dotted lines and that little faint blue line or faint green line were. All of them, as you can see, are above the thick blue line. The thick blue line is today's projection of what happened and what is going to happen. Okay? All the other lines are predictions of what was going to happen a certain amount of time ago. Like that dotted blue line was what it was just in April 2019, and here we are in June 2021. So you can see that there were significant revisions in the data going through, right? So what does that mean? It means that number one, the economy wasn't doing as well as people thought coming into the pandemic. And secondly, when we got there, we haven't bounced back as hard as people have imagined as well too. So this is really important, okay? It's absolutely important to try and understand that things aren't quite going as well as people say they are, despite. Yeah, I get the labour market's tight in some areas, but in others, there's plenty of jobs around, right? So, sorry, what I mean by that is, I'll rephrase that. There's plenty of workers around, but no jobs. Apologies, that's my fault. The chart on the right-hand side is also really interesting because it's a chart of US Treasury yields. Now, why is this really interesting? Well, if you look at the chart itself, you can see that we got 2s, we got 5s, and in big red and in brown, you've got the 10s and 30s, right? So for me, the key yields are the 10 and 30-year yields. So if you look at what's been happening to yields in the course of the last 3 months, you can see that yields have fallen away. Now, hang on a second, you say, but inflation at the same time has been going up. So we've seen inflation go from 1 to 2 to 3 to 4 to 5 in the States. And the last 3 months, we've seen the big jumps. But at the same time, we've actually seen yields fallen. So what's going on? And look at those rates as well too. So the 30 years around about the 2% mark, and the 10-year is around about 1.3, 1.25. Oh my God, well, that's a lot different to 5 point whatever the number was coming out of the States, right? So what is happening? Because that gives you a real yield, when you take inflation away, a real yield that's quite negative. Okay, and that's quite important to understand that is exceptional for the last 20 or 30 years to have those negative real yields. Traditionally, real yields used to be positive. So what's going on? Well, the question, what's going on, is the bond market is telling you that it doesn't believe inflation is going to stay up. What it's telling you is that in actual fact, we've got a much bigger problem than we thought, and maybe inflation is going to go away quite quickly. Is there any other supporting evidence for that? Well, yeah, there is actually. So the chart on the left-hand side, sorry guys, if you can see me, I apologize, but otherwise I'm moving a picture of us around. Maybe I'll just minimize it. That might be better. There we go. Okay, so the chart on the left-hand side is a chart of lumber. Now, do you remember 2 months ago, everybody was saying, there's a shortage of supply, houses are being built at a rate of knots, the price of lumber's going up because there's none around and because there's demand is going through the roof and da-da-da-da-da-da. Well, yeah, the price of lumber did go up for a short period of time. In fact, it went up quite a lot compared to where it was 2 years ago, right? Something in the order of what? 3 and a bit times, okay? But hang on a second, where are we today? Where we are today is we've taken that lumber price of $17.50 and we're all the way back at $500. We have lost something like 75% of that value already. Okay, so this is important. Why is it important? Because if the lumber boom and boomette is over, and God, did it happen quickly? This happened over the course of 3 to 4 months, right? if the boom's over and the market has come back down again, what does that say about the inflation worries in the lumber market and in the housing market? It's saying that either demand has collapsed, so in other words, people have stopped buying new houses, which I don't see happening in the States, or else there's no shortage of supply. There never was. It was just a temporary thing because of COVID that created this temporary situation. And here's that word again, right? Temporary, transitory. We hear that word a lot. And this is the problem that comes in. I normally don't always agree with the Fed, but in this instance, I think Chairman Powell has it nailed. When you look at the chart on the right, the PCE measure is the measure which the Fed uses for its inflation point. And yeah, sure, it's rallying at the moment and it's up there at about the 3 or 4% mark. And so recently it has been rising, but look at what happened for the last almost, looking through this, since 2018. So this is way before the pandemic. That PCE number was underperforming dramatically. Okay, not just because of the pandemic. You see the pandemic dip around here, this area here, but equally through 2018 and early 2019, there was no real inflation. Okay, so this is quite important because although we've caught up a little bit since then, the reality is we're no different to that 2% target the Fed has had in place for 4 or 5 years. We're in fact still slightly behind over the course of the last 5 years. This is sort of what they mean about the averaging effect. They're happy to let it go a little bit on the understanding all it's doing is catching up a little bit of lost time. But the question is, will the inflation remain, right? So, well, this is interesting, right? So will it, right? Will central banks take action? Okay, so this week, right? The news this week, I don't know if anybody even saw it. It wasn't that particularly interesting. The RBNZ, the New Zealand Central Bank, put an end to QE purchases. It was the first government that I know of, maybe the Swedes or the Norwegians have done something similar, or the Finns, somewhere in Scandinavia, I think they've started it. But New Zealand is the first big economy, public economy that I know of who has ended QE purchases. And they're ending them quite quickly. They're stopping literally next week, right? So no more government bonds being bought by the central bank. Now, you'd have thought the natural reaction to that would be the one we saw on the chart on the left. So this is the Aussie Kiwi. 2 or 3 big days down and it really moved. Really moved so much that it moved 1.25 big figures. Okay, 1.25 big figures. Now it trades in a range between 100, right? So parity and 110, right? At the moment, or 112. At the moment, that's been the range for, I think, a number of different years. Okay, yesterday on enormous news of a change, the whole market managed to move a big figure and a bit. Now, maybe it's going to move more. I don't know. We'll see what happens. But this is where I'm starting to get concerned about this whole inflation gig, right? Because what they're really saying is that was quite dramatic, but at the same time, was it really the right thing to do? And when you look at what happened against the New Zealand dollar against the US dollar, in there, by the way, on the chart on the right, I think the third bar back is the move, right? So how long did that last for? Well, it lasted for approximately a day. And the movement was normal, the range of volatility. I can't even discern that anything was said. So this is interesting, right? Because we're getting back to this thing again, is that, so hang on a second, the New Zealand dollar can barely rally on what essentially is an end to the QE process and the beginning of tightening. The New Zealand dollar can barely rally despite the fact it was first off the block to do it, right? So what does that tell you? I'm not sure, but I think it's really not inflationary. So when we always talk about the Fed at the moment, what the game is and what the plan is and what's happening in the markets is that, because the Fed changed those dot plots about what may or may not happen in 2 years' time, they did something in the plumbing of the bond market as well too by raising repo rates at just 5 basis points. That's tiny, right? Then what happened is that the yield curve started to flatten in the States. Now, what do I mean by that? I mean those 10-year and 30-year rates fell a little bit, and the 2 and the 5-year rates probably rose fractionally or stayed similar, right? So the curve began to flatten out, right? Now, it doesn't have to go inverted, so the front end, though the 2s and 5s are higher than 10s and 30s, it just has to start to flatten, and that is taken as being quite a tightening slash reduction in liquidity event. Okay, so and we'll get back to liquidity in a second because it's so important. So one of the key things about the Fed that you have to remember is they're a private institution, right? They give the government loads of money each year for the amount of money they've made, and it gets more and more the bigger amount of bonds they have in their portfolio. But the reality, at the end of the day, it's a privately owned organization. Okay, they have a lot of bonds and they don't hedge and they don't want those yields to go up too much, which is another reason why the yields are staying quite subdued. But I think the Fed really has this nailed. I think inflation is transitory. In 3 to 6 months' time, the rate will start to come down and we'll be worried about trying to keep it up rather than trying to see it going to the moon. So the key thing about all of this is, right, is that the US dollar rally has started. And one of my concerns is I think the market is fundamentally short of US dollars. Nobody is certainly, the market is not overtly long of US dollars. I just think they're on their way to flat, right? Nobody's taking a long US dollar position. They're just not necessarily as short as they were because we've seen the squeeze, right? This is the way the market's been running. So that pseudo tightening by the Fed, the pseudo tightening by the New Zealanders, all of this tells me, yes, there's things that you can interpret that in terms of where the FX rate may be going. And the case of the Kiwi, the Aussie Kiwi is probably the obvious place. But it also tells me that the central banks have got this and they're slowly starting to withdraw liquidity out of the market. And that's the key thing to know, right? So what's happening to liquidity is a key metric. You've just got to keep an eye on all of this stuff, what these guys are doing, right? Because as they draw liquidity out, there aren't as many dollars in the system. And as there aren't as many dollars in the system, right, then the US dollar should start to rise. So when I saw the New Zealand dollar not rallying, okay, because it should start to rise once they withdraw liquidity, that told me that there's actually something else at play here. And there's bigger forces working in the market to strengthen the US dollar. So that's what worries me, and that's what I'm seeing in the market right now. Worry? Yes, let's take it as a trading opportunity. So just to remind you, right, what's been happening, we've seen that fall in yields in the 10-year note. This is yields running, going down, excuse the poor decimal place, but we're down at about 130 at the moment. But at the same time, the US Treasury market has been rallying. So it's not because of higher interest rates in America that the US dollar has been rallying, right? What's been going on is it appears to me that people are on the wrong side of the boat, right? And they were all selling US dollars around the world, and now they've been forced to cover some of those positions again. Now, what may be going on here is that there may be a shortage of treasuries, which is the reason why the yields are so low, right? People are just trying to buy them, do whatever they can. I've heard talk about collateral issues in the market, which is a bit complicated, but back to that plumbing thing again. But that would essentially reduce some liquidity and cause a shortage of US dollars, which would also cause the US dollar to start rallying, right? So there are some interesting things going on. So when we look at this, what do we think about the commodity markets? Well, if all of this is true, if the US dollar is rallying, it's pretty clear to me that traditionally there's a correlation, right? And that commodity prices come down as the US dollar rallies. Well, if that is the case, then what we need to do is to focus on some commodity prices. We had a brief look, didn't we? We had a brief look at what was going on in lumber, right? And lumber very clearly turned at about the same time the US dollar turned. I don't know why it chose that particular moment in time, but it's interesting nonetheless. And as the lumber price has come down, the US dollar has gone up, right? There has been that traditional correlation. When you look at other markets, not so. But it appears that some of them are beginning to turn. And don't forget, the major buyer in the markets is China, and they've been talking about reducing their purchases one way or another, right? So through either releasing stockpiles or starting to cut back on the amount of coal that they're burning. All of these things, right? There's talk in the markets about how the Chinese are going to try to manage their demand for the commodity markets that people have come to rely on so much, right? The Chinese are always there, right? So we said this last time, right? China, makes a lot of lithium, it makes a lot of cobalt. It also has a lot of rare earth metals. Australia is another great country that has a lot of those, and it also has a strategic ore stockpile, right? But when you look at what's been going on, has China really been driving all of this commodity boom of late, right? The last 3 or 4 months? Well, some of it on the demand side for sure. But a lot of it, as you can see price-wise, has happened because of financial speculation in those commodity markets, right? So in other words, it's the traders that are moving the prices up because they're simply trying to buy everything rather than the producers or the consumers. So looking forward, what information can we glean about where we sit today, right? And that's what's important because we're always thinking today about tomorrow. So does the stock market know something? So here's a whole series of sector charts on the left-hand side against the S&P on the right-hand side. Okay, so let's have a look at some of these. So look, the first one is transportation. For the last 5 weeks, the transportation index has been falling. Now, 92 to 81 doesn't sound like a lot, but that's actually more like 14, 15%. In most years, that would be a disaster, right? It's almost a definition, well, it is a definition of a bear market, right? Which some people would have about the amount of losses in that particular sector. Looking at the oil and gas has fallen almost 20%, right, from the highs 4 weeks ago. Oil is only just starting to roll over now, but oil and gas, the underlying shares behind it, have been falling quite quickly. When you look at the energy sector, Spider, slightly different makeup, that also has been falling 56 to 48. Okay, that's only 8 out of 56, right? But that's still a reasonably substantial amount. That's still, you're looking at 13, 14%, right? Then you look at materials. Materials have had a bad month as well too. And then you look at the metals and minings, and they're also having a bad month. Metal and minings are down something, they're down like $8 on 48, right? That's a 16% fall. So these are actually big moves. Okay, really big moves, and they're not over yet. I haven't come here to pick a bottom. What I'm just saying is look at what's been going on. On the right-hand side is the S&P 500. That's still powering up. So with all of this negativity in these other sectors going on, you still got the S&P 500 going up. So what's happening here? What's happening here is the real economy is starting to slow. There's the key message, right? So that's why I keep talking about transitory inflation. That's why I keep talking about maybe this hype in commodity markets has run its course and we have to come off a little bit. Maybe this might end up being a buying opportunity from a trading perspective. And so how do we think about that, right? Well, not yet, right? Perhaps soon, but we have to wait, and these things have to put in some kind of medium-term bottom, not just a spike bottom on the weekly. We need something else to hang our hat on, right? But equally, what does that mean for the commodity currency exchange rate? So the Canadian dollar, the New Zealand dollar, the Aussie dollar, right? Those three, right? Big commodity exporters, right? What it means is that the outlook for those against the US dollar for the time being is going to be one where they should probably continue to weaken. We've seen what the underlying stocks are doing. If this is what's going on, if you like, in each sector, and this is what the CFOs or whoever is telling the investors is this is what's starting to happen, then it wouldn't be a reach to say that the Canadian dollar should continue its decline against the US dollar. So dollar CAD goes up. You could easily see the Aussie come back a little bit, and you could also see the New Zealand come back a bit into the mid-60s. You know, neither the mid-60s or the 70 level in the Australian is actually a bad level for those things to get to, and they're probably due a consolidation of some kind, right? So there's our trading point, but that trading point is built on a view that inflation is a little flaky, that we're seeing the commodity boom, which has sort of pushed that inflation via the tightness in the transport market, right, has pushed that inflation into the system, if you like, demand pull on one side, but equally supply constraints on the other, right, seems to be beginning to be resolved. Okay, so this is why this is so important to follow these incidental markets. So guys, so when it comes to commodities, I always like to look at China, but have an eye on those individual stock sectors. You had those numbers up there, so you can see this, right? XTN, XOP, XLE, they're all available, those key sectors. Anybody can get them on any chart package and just have a look and see how they're trading. It may give you some clues. I believe inflation is here, but not for long, right? The Fed, once again, with their dot plot move, has clearly changed the way the market is operating. So what's important from here on in, right, is the next Fed meeting and Bretton Woods, which is coming up in August usually. Okay, so those two things are really important to try and get a feel for where the market is and what's going on, right? And the key thing is, does it change our view of the world? Well, these things we have to put into our equation for when we trade. So if you believe that the dollar CAD is going to continue to rally, you'd be looking to try and buy weakness in the trend, right? Because that makes the most sense if you're a cautious trader. I think trying to buy breakouts at the moment is quite tricky, but if you're a cautious trader and a patient trader, you'd be looking for those consolidations to be able to put positions on again to buy the dollar, the dollar CAD long, and maybe sell the Aussie, sell the New Zealand. And then what you need to do is just trade the weakest one of those three, right? But the key thing is, right, as I keep saying every time, right, what's really important about all of this is it's always important to just look and see what the price action is doing. Okay, so when I think about that, I think about keeping an eye on my Super 6. I talked about, getting the right amount of information. So I would always have in my mind the Super 6. Now, what are they? Okay, the Super 6 is two exchange rates, Euro US dollar. Okay, why? Because that's the two big trading partners across the Atlantic. You have to have both of those, and that's a really important cross rate. And similarly, dollar yen, right? Another really important cross rate. If you wanted to, maybe throw in the dollar renminbi as well too, right? So that you have that Chinese element as well. I put that in brackets because it's not really a true floating currency. Then I'd like to look at a couple of commodities. We need to look at what's happening to gold. Always we look at what's happening to gold. We need to look at what's happening to oil. Again, always need to look at both of those. Friday was a bad day for both of those two commodities, right? After we've done those two, what are left? So we've had two currencies, we've had two commodities. We need to look at 30-year Treasury bond yields. You can get them on any chart anywhere, right? Loads of information about those. Just look at the 30-year bond yield and the history about how it trades. And then finally, you need to look at the S&P 500 and or a local stock market, right? That gives you like a Super 6 or a I don't know, let's call it a sexy 7 or something like that, right? The markets, you absolutely must know where all the prices are and what's going on with all of them. They all have their idiosyncrasies, and what's important is what determines the flows between them, right? That's why it's so important. So I call it the Super 6, and I recommend to you guys that you do it. So look, something that's really I keep an eye on every single month whenever we look at this is what's going on with the Citigroup Economic Surprise Index. So what's this, right? It's an index whereby the economists guesses about what they think is going to be the economic figures and what actually happens. So what's been happening recently is the economists you can see back in 2020, the economists were more optimistic initially about the pandemic than what actually happened. Then they were very, very pessimistic about the pandemic, and the optimism for the real economic numbers came through. In other words, things weren't as bad as we thought. And then recently this year, we've had terrific problems because the economists seem to be getting everything wrong because the economy is slowing down a little bit or underperforming what their expectations were. And now we're back in this level just here right now where it's almost flat, right? So almost let's say the economists and the economy are behaving themselves, right? So that's sort of what you'd expect as you come out of the pandemic, but I still think it's way too early. And I keep an eye on this because if this dips below the 0 mark, that's not good in terms of where things are trading. And hey, look, the last thing we've got to think about, right? I haven't really touched on government deficits because quite frankly, they're not really moving at the moment. It's summertime and a lot of these guys are on holiday in the Northern Hemisphere. So governments really aren't doing an awful lot. So I think we can park that one until the autumn. But let's talk about the COVID-19 pandemic, right? So I see this as a transition from pandemic to endemic. What do I mean by that? I mean, people are going to come out of lockdown because they're really frustrated now. They don't want to be in lockdown anymore. And what they're going to do is they're going to get the economy, tell the governments, let's get the economy working again, and we just have to manage. So by managing it, what's got to happen? Lots of people have to be vaccinated. So here it comes, right? If you look around Asia, why are all the case counts going up? It's because the vaccination levels are quite low. Australia is a classic example of one who hasn't got it right at all. Okay, they've got multiple lockdowns going on. They were too slow to vaccinate, and here they are back in lockdown again. right? You look at the UK. The UK had Freedom Day. I think it's this week, either today or tomorrow. I'm checking the date. I think it might be tomorrow. Freedom Day, where they're allowed out, right? And things get back to normal again. And they've said, look, we've already got 60% of the population vaccinated. Those who haven't been vaccinated, well, come on, guys, you've had loads of opportunities. We've got to open up and we've got to get the economy going again. So we're not going to lock it down again, right? And so this is why this is quite important. So in the UK, you will see different economic performance compared to Australia. That's why we have to keep an eye on this. And if Indonesia and India and Malaysia are all suffering from a spike in cases again, we've got to suspect that if they haven't got a lot of people vaccinated, they'll be forced back into a lockdown, which will hurt economics, which will then hurt their currency, right? So just bear in mind these movements. You have to understand in very vague, broad terms what's going on, right? And then try and pick away at it, right? So in the States, they've reopened. We know they've reopened. They've been reopening for a little while, but now the case count's going right back up again, and they may be forced one way or another to think about locking down again. Well, that would be a disaster. So what would that do to the US dollar, to trade relations, to the S&P 500, and subsequently to the dollar index and all the other currencies as well too? These are things we have to keep an eye on. Guys, they're not going to come out the blue at you. The information's all there. You've just got to try and piece all of this together and say what's important at the moment. So probably my ideas about inflation being transitionary, you can begin to see it in the data, but it's not as important as it's going to be in 3 months. The pandemic to endemic, I think, is right in front of us here. Okay, the economic divergence and things are not the demand, if you like, that super demand we had. Well, everybody had a little bit of money during COVID lockdowns and they weren't spending it on cafes or restaurants, right? They spent it on other things. So that demand pull has now working its way through the system. People are getting back to normal. Okay, and then if you go lockdown again, then people won't start buying more washing machines. They've already bought them, right? So have a think about what that means as well too. So guys, look, this is the way I'm thinking. This is the end of the slideshow. These are the 3 key themes. I like to go through these, and if anybody has any questions to ask, then please ask away. Let me just find the chat. We've got 9 points here already. Oh my God. Okay, so hold on a second. I'm just going to just move this up here so I can read it. So hang on a second. Hopefully I can talk to these points. Let me just stop sharing for the time being. Get back to looking at my mug on the screen. Okay. So Crystal's asking, is the end of QE supposed to be good for currency strength? So the answer to that is sort of yes, Crystal. So if you think about it, QE, the perception, right, and this is important here, the perception is that when you have QE, you're printing lots of money. The reality might be something different, but that's the perception. Okay, when you end QE, the money printing that is perceived to be less. So if it's perceived to be less, that means there's less dollars or less yen or less euros out there, right? So there's always demand, which means that if that supply starts to dry up, what do you think will happen to the currency, right? So that particular currency should start to strengthen. That's the theory. So in other words, you reduce liquidity, the currency should start to strengthen. I think that's what's going on with the US at the moment. Lewis, the tech sector is indeed supporting the market once again. I think it's really hard to hold back the animal spirits in that market. Look, it makes a lot of money. It's incredibly successful, and you can see it's been doing very well. But this was supposed to be the time when the real economy shone. So why isn't it? Gary, South Africa is sad, and at the moment has a lot of problems. I am very bearish on the South African rand. I think solutions to all of this come from, yet again, another weaker currency. I think we're going to start that process again in South Africa. I think from a trading perspective, I'd be looking to buy the dollar ZAR, to be honest with you. I haven't looked at it recently and I don't have any recommendations around it, but I think it's logical to assume that country has a lot of problems that are more than skin deep. And you know what I mean by that. They're more than superficial. There's some structural issues there, which I don't think are going to be resolved anytime soon. I apologize. I didn't mean anything by that previous comment. For gold, which affects the price more, bond yields or the US dollar strength? Great question. Thanks, Lewis. The short answer is I'm not sure either. You have to go with the flow of the fashion. Do you remember a little while ago, everybody's saying rising yields seems to be driving the gold price down. So we've had falling yields for 3 months, and yet the gold price hasn't rallied. So what's that about? Well, that didn't work, did it? Now it's, well, the US dollar strengthening, so gold should go down. Well, maybe that is a correlation. I don't know, but there's no history of it being the case. So when you go back and try and look at that correlation, that doesn't work either. For periods of time, very short periods of time, you're right, it can. So follow that fashion and work that way, but understand it's nothing more than a very short-term fashion. The one you're missing, Helen, is the 30-year US Treasury bond yield, and no, cable is not. And the reason why cable is not a core part of my Super 6 is that it moves incredibly similar to the euro. So I only need one in that region. Euro's far bigger than sterling in terms of importance, so that's why I chose the euro. Yeah. Okay. I'll let Gordon add the Aussie yen to that as well too. And look, Fabian, the answer the answer to cash is king. Once again, cash is never king. Okay, I always like to think about the I've transformed the way I consider investing in the last few years. This is probably actually quite interesting because how much time have we got? Let me just double check. Oh, we've got plenty of time. So I tend to look at it from a different perspective, and I say, well, I always look at the exchange rate, right? So if you're looking at lumber, right, why don't you think about it this way? It costs, I don't know, $500. It's not a metric ton, but whatever the thing is for the lumber that we saw, right? And that's the exchange rate that you're using to buy wood. Well, what you've got to sit down and think about is if I buy wood at this price, will in 6 months, 9 months, a year's time, that would be worth more in terms of its rate of exchange against the US dollar or against, call it, cash. And I think that's the way to think about any of these assets at the moment. Very few assets are yielding anything. So every time you've got to think with all of them, well, is it sufficiently cheap that I think I'm safe from a risk perspective to buy it? And secondly, in terms of how I think about it, I always want to think about every one of them as having an exchange rate. It's the same thing as if you're buying a house, right? What you're actually doing is swapping money for a whole bunch of assets, right? So the idea behind it is if you do that, then you're hoping to be able to get more money at some point when you sell that asset in the future. Okay, now they may pay you some income in the meantime, but that's really secondary to the capital gain at the moment worldwide. So that's how you have to think about it. And I think that sort of look and style of thinking about it means that probably if you then take that a stage further, you should never really be in cash at all. It's just a different exchange rate that you'd use, right? Yeah. So look, there's two ways to do this, right? And thank you. So guys, what Fabian's asked here is he's talking about holding more cash in the portfolio, so a greater percentage of cash in the portfolio in these uncertain markets, so reducing risks. The short answer is if you don't have a choice, you're either long of something, long of a whole bunch of assets, or you're not. Then yeah, if you're worried about those assets falling in price, then absolutely you should try and do something to reduce the risk. And I always say you hold enough positions or enough assets to the point at which you can sleep at night, right? That's a great metric that I've used over the years, which has kept me quite comfortable with the assets and the positions I've taken, right? So yes is the short answer. If you don't have any other choice, then cash is the best alternative. But if cash doesn't pay you anything at all, and traditionally through time it's going to be worth 5% less in a year, it's depreciating like crazy, right? So what do you then say? Well, I've got to try and remember that I've got to try and get out of this as soon as I can, because I'm on a minus 5% interest rate straight away every year. So I know there's a carry. So what you're really saying actually is that the assets I'm holding are going to make more than 5% a year just to stay in touch with the rate of inflation, right? To protect my net worth. So if that is the case, then, and that's a good way of thinking about it, then you probably don't want to hold that cash for any length of time. You want to sort of be owning something. So I agree. Look, every year there's usually a big puke, right? Somewhere, sometime in the US markets, equity markets, or somewhere, something gets cheap. Okay. I think we're going to get cheap on some of those material stocks that I was talking about earlier, and the energy stocks. I'm quite bullish on them. I think there's an opportunity to purchase something a little bit later on, good yield, yada, 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 right? But is it the low today, this week? No, but I think that it will be. And for the record, I've moved into, I've sold some of mine recently. And actually, what I do is I tend to own inflation protected securities as my hedge. So I don't actually own cash. I just have everything in inflation protected securities. So whatever the inflation rate is, and I'm linked to the UK and the US, then I take advantage of that. So in other words, that guarantees my 5% comes back to me, if you like. That makes sense to you. So I think that's quite an interesting way of doing it. And there are other instruments out there that you can use, right, with a little bit of thought to have a look around the market to give you that sort of inflation hedges no matter what, right, and also protect you from a lot of risk. Look, Helen, Argentina, it did pull through after some bad times, but one of the great challenges about inflation is that inflation doesn't really hurt anybody but people who are on relatively low incomes. And I think that's a real problem. So I've never been a fan of inflation as a solution to financial issues, right? So if people who go around saying, let's inflate all the debt away. And I go, yeah, great, okay. But in the meantime, while you're inflating all that debt away, a lot of people are getting quite poor. Okay, and they get quite noisy, and so usually inflation normally tends to go with civil unrest as well too, or some kind of political change. So just bear that in mind before people start walking into the inflation is good camp. However, 10 years of 5% inflation, all of a sudden all those debt to GDP ratios look a little bit annoying because they're way, way, way lower, right? So if the government didn't borrow any more money from today and we walked forwards 5 years and inflation is 5%, then you compound that, and that debt to GDP ratio has already fallen 30%, which in most cases would be halfway to getting everybody out of their problems. 10 years and all these problems go away about all this worry about too much debt and everything. So Crystal, inflation-linked bonds. So in the States, they're called TIPS, and I think they're called TIPS in the UK as well too. Most countries have them as part of their government borrowing, so you can access them in most developed countries now. And yeah, they do. So what happens is you buy short-dated ones, so like 5-year ones. What they do is they will then every year they re-index to what the CPI rate is. You need to look at what that rate is that they index to. Sometimes that's a bit confusing. So you're sort of protected from inflation. This isn't a recommendation, obviously, to go and buy them because I'm not a financial advisor in your jurisdiction, but just bear in mind that I think it's something worthwhile looking at as a alternative maybe to holding cash. It might be quite useful. For those people who are interested, then they do tend to have some of the characteristics of short-term bonds, so they can go down. But the reality is every year they get reset higher because inflation's higher. Cool. I hope that's answered loads of questions. There's been loads of questions. I think I've got all of them. Does anybody have anything else they'd like to ask? Otherwise, I think we might just wrap this up, actually. Okay, guys, thank you very much. I'll be giving a very much shortened version of this in the TTR in a few minutes' time. So thank you very much. And as always, folks, if you have been, thank you very much for listening. And we'll see you again next time.